Welcome back to Truck Tech, everyone. This is Alan Adler, your host here at FreightWaves, and I am fascinated at that there is so much in the space of electrification that we have to talk about, and we seem to keep coming up with sort of fresh, some repeating, but mostly fresh topics. Today, we're going to be joined by Scott Davidson, the CEO of Revolv. Revolv is one of the companies, there are many, that are working to bring sort of turnkey solutions really to electrification so that companies that are trying to get their business done do not have to spend their time wading in unfamiliar waters, which is electrification. So Scott, thanks for joining us. Welcome to Truck Tech.
Wonderful to be here. Thanks very much for having us on.
You're welcome. It's so funny because, just recently in the Truck Tech newsletter, which is a Friday activity, apart from the podcast, we were talking about the financing of the electrification space, of getting, infrastructure, chargers and things like that. One of the things that came up very quickly was, this is not a new story. It is something that we've seen before. And you come from a background in solar, which went through this already. I think you said you've seen this movie before. I'd like you to kind of take us through the plot line of that, if you wouldn't mind, just for starters.
Yeah, sure. I'd love to. If we think about some of the headwinds that are faced for the electrification space right now, and in our mind, they distill to sort of three broad topics: cost, complexity, and risk. So most of the barriers for fleets right now can be associated or categorized to one of those two broad buckets. It's something that we saw in the solar space over a decade ago, which is where I spent a lot of my time before dedicating time to the transportation space. And what we saw with commercial buyers specifically was similar challenges. And most of it was buyers wanted to move towards clean solar in the case of my previous experience, but they didn't want to buy panels, inverters, or work with contractors. What they really wanted was clean energy that was at a compelling economic and performance-based solution. And I think what we're going to see in the transportation space is a similar emergence as fleets begin to realize that this is more difficult than simply buying a truck and plugging it into the wall, right? There is programs that the best fleets are starting to build around figuring out where and how to do electrification. And I think the solar space can teach us a lot of lessons in terms of not only the current customer barriers, but also what's happening in the broader market in terms of how the market is likely going to evolve over time. And we can talk more about those broad themes if they're of interest.
Well, we've got two things happening, obviously. The first is we've got regulations that are pushing it. And especially in California, we're doing, the bulk of your operations at this point. You've got the California Resources Board that has, brought us two things, both the Advanced Clean Truck Rule and the Advanced Clean Fleets Rule, essentially making a market for electric vehicles, right? I mean, that's kind of what they're up to. And then you've got, on the other hand, also from CARB, the incentives to help make this happen. I mean, in terms of, the HVIP program and the utilities programs and things like that to, make it work kind of sort of get you closer to parity with either gasoline or diesel, depending on the size class of vehicle you're talking about. It's interesting to me that we've started to see, though, and we'll come back to the bigger picture, we started to see a bit of a slowdown. You saw that with solar as well, I take it, and then it came back, right?
Yeah, I mean, these are the natural ebbs and flows of a market that is immature, right? It is. I think there was an exuberance around the electrification space in the last 2 years, and you saw a lot of capacity get built into the market, whether that's from OEMs or press announcements from people, and it's natural as people get excited. The market tends to lead customer adoption in many respects, right? A phrase we often like to state is, don't mistake press for progress, right? So I think what we were natural to see is these checks back in the market where people sort of moderate their expectations and recalibrate themselves to what fleets are actually thinking and doing in the space, what they're most interested in, what is possible as opposed to what the industry wants to achieve. And I think it's a healthy thing for the market. But I think we shouldn't be confused about the short-term oscillations that we see in a broader term theme, which is growth, right? And I think this is the exciting part for us. We're excited to be building into the market when everybody is pulling back. We're leaning in because we see a real opportunity to help fleets achieve economic based adoption,
Well,
not environmental based
that's a very
adoption.
Warren Buffett approach, right? When others get weird, then you go forward. So let's talk a little bit about your business and what you're doing right now. I think you said you have 20 installations in California. Makes a lot of sense because California is leading this activity. You are primarily focused, though, in the areas where the total cost of ownership makes more sense. That is sort of that class 2B up to maybe 5. Would that be the right description? And you're working with these customers. And again, you're not alone. We've interviewed many of your competitors over time. And the idea is, I don't know if turnkey is the term you would use, but certainly get all of the stuff off of me. You go take care of this and just give me, like you said, with solar, give me the energy, energize me, electrify me, whatever. Maybe you could talk how you're doing that. I want to really get a good understanding for our audience because I think that there are opportunities to just turn this over, and that's what you're asking, right?
Yeah.
Turn it over to me and I'll do it.
We hear a lot of discussion around turnkey, full service. And I think it must be hard for fleets to distill what that means because a lot of people are using them to mean different things. So I can understand in some respects why it's just creating more confusion. The way we like to think about our solution is really about more than turnkey. Turnkey is a moment in time. That is, you turn the key and you start, as in, here's your electrification, I'm handing you the keys. But our belief is that's just the beginning of the process. It's not the end. When you turn the keys of an electric vehicle over to a driver, to a site manager, it's not a set it and forget it approach. Our approach is performance driven. That is, we're with a fleet not only until we help them determine where it's best operationally and economically, and then we manage the change management program about installing it. But then after it goes live, we're also there with fleets to be able to help drivers understand how they need to adapt behavior and how we can continue to build a program on top of that. So as I said, turning the key is the start, not the end of the process. And we like to think about our solution as a big warm blanket that helps fleets understand that everything is going to be connected and operating and running on a daily basis, right? As opposed to a set it and forget it approach. And I think that's what really sets us apart in the market is that we sit on the same side of the table as the customers in that sense.
So what you're doing basically then there's consultant function throughout, but in the beginning, there's sort of that, let me have a look at what you're doing. Let's see what we can, what makes most sense for you to electrify now. What does it look like, 3 years from now? But one of the things that you're clearly doing is removing even the vehicle purchase or lease piece from them and saying, here's the vehicles that would make most sense. And again, from a TCO perspective, because that's what these guys are looking at, right? I mean, at the end of the day.
Yeah. And I think it's probably a good opportunity to sort of talk about electrification as a system as opposed to individual components, right? If you think about a stereo for a system, for example, the quality of the sound that comes out of the speakers is a function of the weakest link in that system, right? You get the best amplifiers, the best speaker, but if you have terrible speaker wire or a bad connection, your sound is going to be terrible, regardless of the quality of the components. So when people think about electrification, they need in many respects to be thinking about that connectivity of all the solutions in between. And I think vehicle is one component of it. We put our arms around the entire hardware and software solutions that allow fleets to buy what they care about, which is economic miles at operational parity. So we warehouse the technology risk for vehicles on behalf of those customers and most importantly, make sure that everything is connected and working together, which is, if you talk to fleets, is where a lot of the pain and suffering is after operations is connectivity between these systems, right? And tools.
Right. Okay. So let's talk about one of those components in this. I like your analogy of the stereo system. I think that's pretty cool. Let's talk about one of those, which is charging. And I presume that a lot of what you're doing is behind the fence charging because it's going to be for a particular fleet. Is that correct? I mean, you're not really out there setting up public charging facilities, are you, or are you?
That's right. We are not. We are focused on meeting fleets where they operate. The market is enormous. There's an enormous opportunity for multiple business models to be able to serve specific fleet needs. And our choice is to determine where fleets are operating and how we're operating vehicles and to help them stand up electrification behind the fence at their existing facility, right? Manage the utility, manage the permitting agency, managing the landlords and the real estate agreements. That is where we spend all of our time, is behind the fence, because we believe that that's where we can do it most cost effectively for fleets. It's more difficult in some respects because it's individual power requests in different places, individual tariffs at different site facilities, it's individual permitting agencies in different facilities. But that's the same thing a fleet needs to face if they're going electrification. If they have 10 sites throughout the state of California, by themselves, if they're buying a la carte, they need to be thinking about all those discrete decisions and how they stitch together into that complete solution. So that's why we've chosen to focus behind the head fence for fleets.
That brings up a good question. I imagine at the lower classes, you can do fine with level 2 overnight charging. Are you also engaged though in DC charging as well and doing, where trenches are needed and things like that? Are you bringing that to pass?
We absolutely are. And we're looking at technology that's behind the fence that can help allow in a larger amount of power behind the fence for use without triggering utility upgrades, again, which is a unique capability set that most fleets don't have internally. So we are agnostic on technology, both vendors, but also the type of technology. We will again look at a fleet's operations and say, okay, what are they dwelling overnight? The size of the charger and the charging protocols will be defined by how fleets are using their vehicle. And again, that's a big optimization question to say. If a fleet says, I don't want to make operational compromises, which is what I would do if I was a fleet, tell me how you get the right technology to allow me to perform, including speccing the right power charger relative to dwell cycle, which is what you referenced.
Revolv must have its favorites out there in each of these areas in terms of, chargers and things like that, because, the more business you can throw at I'll make it up, an ABB or someone like that for chargers, the better for you, right? I mean, that's another way for you to make your business go because of volume and what you can, I presume you have your favorites then, in each of these areas.
We have a lot of insight as it relates to the performance of different chargers and different vehicles. We have over 8 different OEMs in operation in our fleet, and I think probably close to 3 or 4 different charging providers. Just on the hardware side, there are charging providers that we've gone into and removed the chargers and replaced them with others. Again, a customer is not aware of it because we've decided operationally we want to improve uptime, and we've made the change for fleets. Again, fleets, we provide performance, not the hardware is a means to that end. Right. So we get a lot of visibility in terms of which chargers to use. But again, we have skin in the game to make sure we make the right technology choices. Because if we don't, it's us who has to deal with it. And I think that's what is a powerful differentiator to say that we're selling performance. We're not selling products. And we will prefer vendors who have exceptional performance and want to reward those vendors for the exceptional performance.
Well, and that in one case, if I'm going to stay with the charger example, that's uptime. Are those chargers up and running? Are they, well taken care of? I want to go back just a moment to your founding though. You were founded, either beginning of or just before the pandemic. There were a lot of supply chain issues, especially with switchgear and things like that. Yeah. It made it very difficult for anybody, to get up and running. Did you have to go through that as well? In terms of your installations, even behind the fence?
We did. There were definitely supply chain related constraints for us to work through, but we were also fortunate that was in the earlier stages of our business. We were building initial deployments for customers that were below 4 or 5 vehicles. So in many cases, we were able to identify the sites where we could deploy without having to rely on long lead or short availability equipment. So we had a lot more flexibility in our business. But what we've seen is it's wonderful to see that fleets are no longer thinking about pilot projects as 2 or 4 vehicles. They're saying, wait, I understand we need to deploy at scale to get the cost down. So now our initial deployment customers originally started with 2 to 4 vehicles, and now new customers are deploying 25 vehicles at a time. And that's a real significant change. We're allowed to do it because supply chain availability, but it's also, we were just fortunate in terms of the timing of our business, our merchants, relative to the constraints that were in the market.
Let's talk a little bit about where you are. I think you told me you're sort of Series A plus. You're beyond that. You've got a decent debt facility to work with that basically is it doesn't threaten anything other than the collateral that you put into it. I understand that these tend to be a little more expensive, from an interest standpoint. You could tell me if that's incorrect, but at this point, your customer contracts, and I presume these are of some length, 3 years and up, to have customers. That's the kind of thing that can make collateral that can allow you to scale this. Is that right? Am I
correct? And I would say the distinction between Revolv's model and where other people are approaching the model is a lot of people are raising debt either at the corporate level or at the project level is as one way to be able to fund development for the business. And the sizing of that debt will be a function of the risk and the collateral on the other side of the debt and the certainty of the cash flows that come from that. Our model is slightly different. The second model is private equity players who have funded these businesses, and they're largely deploying. There's no distinction between the equity that they use at the corporate level or the project level. And the distinction and the thing that we're most excited about in Revolv's case is, and the partnership that we have with Greenback or GREC is an equity-based facility, just like was built in the solar sector, which is comes in and acquires the projects that are financeable at commercial operation date. So it's not debt, it's equity. And they have a right to the cash flows associated with the business. And in our estimation, it's the first non-recourse project finance facility built for a performance-based solution for fleets that is non-recourse from our corporate model. And that is a really important signal, Alan, because there is an unlimited amount of capital that is sitting on the sidelines looking for attractive risk-adjusted return to deploy into projects. And that's really important because getting that low-cost capital into projects reduces the total cost of ownership for fleets, which in turn improves the attractiveness of the offering and continues to drive the market. So capital markets availability and focus in this business is going to be essential for us to continue to drive costs down for customers.
Well, I'll keep this one simple. Where are your customers coming from? Is it word of mouth at this point, or do you have a big sales team? How are you getting new customers?
Yeah, it's interesting. A number of different sources, some of through the team's existing relationships, some as response to inbound marketing campaigns, some as referrals and word of mouth through our vendors and our partners. We have a really strong collaboration model with some of the partners that we're working with within our offering to customers. And we think about ourselves as standing in between technology, other providers, and not extracting rent, but adding value. How do we help them deploy their products to customers? How do we create transactions that wouldn't happen before? And I think that's what we're getting a lot of opportunity from partners who are saying, listen, I think you, Revolv, can help us solve some of the challenges that we're having to selling our product because you can help us get customers to get comfortable with the things because you're going to warehouse some of that risk for us. So I would say just from general inbound interest from existing relationships and from partner relationships.
You've mentioned that you've had some return customers already that have sort of upsized their orders, if you will. You described it a moment ago when you said, 2 to 4 to 25, that's just one example, but clearly, as customers, and this is so true with any evolving technology, you don't go buy 500 of them the first time out, assuming you needed that many, but you go out and you test the water. And we're seeing that certainly in the Class 8 space even now. I think we just recently saw, Volvo in Europe picked up an order of 300 from one of its customers. We're not seeing that many in the hundreds at this point, but we're probably up to the teens and 20s in some cases. And we've got some examples in Class 8. Snyder is about 100 trucks and, a few others, but, they've got 9,000 trucks. So it's still, what's that? Maersk
Performance team in Maersk.
Yep. Right. You're seeing that. And that's another Volvo one. But by and large, we're still not quite out to the hundreds of trucks yet. Maybe down, you said you have a customer, I think, that has 9,000 trucks, not all electric, right? But some portion of that is electric, battery electric. And you will continue to convert that, I presume.
Yeah, absolutely. I would say, well, let me come back to that, how we convert it and we help fleets, but where to make the decision in terms of what's electric and what's ICE. What I would point to before we go there is that the largest fleets are doing this at scale. Amazon is doing it at scale. Pepsi is doing it at scale. There's a number of big UPS, a number of fleets that are doing deployments at scale because they see what we see, which is electrification is going to be a better economic and operational solution in the future, right? It's not today in all applications, but there are applications where it's at or below cost today that we help fleets find, but they know in the future that this is inevitable. Electrification is inevitable. Costs are continuing to come down. Performance is continuing to come up. So the smart fleets are moving first with investments to be able to prepare their businesses for when that economic inevitability is. And I'll maybe, if I could, Alan, come back to the solar example just to draw something that will help frame the picture. When the solar market first emerged, it was, as you referenced, California regulations, CARB today in electrifications, RPS, Renewable Portfolio Standards for energy in California, and those started to emerge in other markets. New York and other markets were following California's lead. You're seeing very similar things emerge in the United States with advanced clean trucks and advanced clean fleets. So there's a regulatory driven creating demand, as you put it, which I think is a great way to frame it. But if we pause and say the markets are not just going to be regulatory driven, if you look at the solar market, the two biggest solar markets in the United States are California, which is regulatory driven, and Texas, which is economic driven, right? No regulation in Texas drove adoption of solar and wind in that state. It was 100% economic driven. And that's what's going to happen in this space. It's going to be economic driven, right? There's three types of buyers for fleets. There's the sustainability driven fleets. I want to do this for the environment. There's the regulation buyers, and then there's the economic buyers. So we're increasingly going to be moving in the direction towards economic buyers. So those big fleets see the economic necessity and they're preparing for it because they know as soon as they have to do it, it's going to take them time to build capacity.
Sure. Scott, let me get you out here on this. Believe it or not, our time is just about up, and it's been really delightful because you brought some perspective to this that we don't always get into. And sometimes even if it is reinforcing some things we've heard before, that's good. But you've actually brought some different perspective, which I really appreciate. I'm just going to ask you the H word real quick, and that's hydrogen. Is that part of this for you at any point, or is it something you consider?
Not today, is what I'd say. The hardest challenge with hydrogen is infrastructure. It's not the total cost of ownership of the vehicles themselves with subsidized hydrogen in select markets. It's how do you build the fueling infrastructure at scale? So we've been asked to look at it. We have looked at it, but we just think that there's a much more compelling opportunity in the electrification space. We're going to continue to deploy technology that makes sense for customers. We just don't see a compelling relative to electrification business case for it today.
Right. Okay. Well, Scott Davidson, thanks so much for being part of Truck Tech this week. This is, like I said, this is fascinating. I hope the audience enjoyed it. Folks, we're going to be back with a new show again next week. Just want to remind everyone that the Future of Freight Festival is coming up in November, mid-November in Chattanooga. We still are offering discount coupons for ticketing for that, so we hope you take advantage of that. And we're also coming up very quickly now on the closing of the nomination period for the Freight Tech 25. You have until September 6th to get your nominations in. You might get a pop-up if you go to freightwaves.com, but you can also find what you need to do those entries there. For everyone else, thanks for joining us, and we'll see you next time.